So, what if I told you that the US tax code, all 6,000 plus pages of it, isn't just a rulebook for what you owe, but more like a treasure map? A map filled with opportunities to legally keep more of your own hard-earned money. It's pretty wild, but some estimates suggest high-income folks and corporations can legally shave tens, even hundreds of billions off their tax bills each year. How? Simply by understanding these complex, but often public, rules. It's not always about finding sketchy loopholes, it's about knowing the lay of the land. Think about it for a second. What if you could legally send thousands, maybe even tens of thousands, from the IRS's pile right back into your own savings, your investments, or your business? Sounds like a dream, doesn't it? Especially when you're staring down that hefty tax bill every year. But here's the thing, many high-income people and smart business owners are doing exactly that. And the strategies they use? They're often not as secret as you might think, but they are criminally underused by the average person. Today, we're pulling back the curtain. And let's be clear, we're not talking about illegal tax evasion. We're talking about smart, legal tax avoidance, using the tax code, as it's written, to your absolute best advantage. We're going to dig into some powerful, often overlooked tax breaks and strategies that top earners and clever entrepreneurs use to seriously slash their tax obligations. Stick around, because what you learn today could genuinely change your financial future. Now, why should this even matter to you? Well, if you're a high-income W-2 employee, you probably feel like you're carrying a massive tax burden with not a lot of ways out. If you're a business owner, you're already juggling growth, expenses, and that constant dread of tax season. That feeling of watching a big chunk of your income just vanish to taxes? Yeah, that's pretty universal. But here's the kicker, the tax system, as complicated as it is also packed with incentives. Incentives for saving, for investing, for certain types of business activities, and even for how you handle your health expenses and charitable donations. The wealthy don't just earn more, they often understand how to make these incentives work overtime for them. The good news? A lot of these strategies aren't just for the super rich with teams of accountants. While getting specialized advice is absolutely crucial, and we'll talk more about that, just understanding the concepts is your first step to taking control. The tax code is like a game, and it's time you learn the rules the pros use. By the end of this, you'll have knowledge that can, quite literally, pay dividends. Alright, let's get into the strategies. I've picked out a few key areas where top earners often find some pretty significant and totally legal tax advantages. Some of these might actually surprise you with how accessible they are. We all know about 401(k)s and IRAs, right? Definitely max those out. For 2025, the 401(k) contribution limit is $23,500, plus a catch-up if you're 50 or older. The IRA limit is $7,000, plus a $1,000 catch-up. These are fantastic starting points. But top earners, especially business owners or the self-employed, often go way, way further. How do they pull it off? They look into things like solo 401(k)s. If you have any self-employment income, even from a side hustle, a solo 401(k) lets you contribute both as the employee, up to that $23,500 in 2025, and as the employer, up to 25% of your compensation. This can seriously pump up your tax-deferred savings. For 2025, the total you can stash in a solo 401(k) can hit up to $69,000, depending on your income. Then there are SEP IRAs, Simplified Employee Pension. These are also a big hit with self-employed folks and small business owners. You can contribute up to 25% of your net self-employment income, with a maximum of $69,000 for 2025. That's a powerful way to sock away a large sum and cut down your taxable income for the current year quite a bit. And for those aiming for even bigger deductions, defined benefit plans, think old school pensions, but you set one up for yourself or your small business, can allow for six-figure annual contributions, especially if you're getting closer to retirement. These are more complicated and need actuarial calculations, but the tax deferral can be absolutely massive. The secret here isn't just about saving for retirement, it's about using these supercharged accounts as a key tool to slash your current taxable income, letting that money grow tax-deferred, or even tax-free with Roth versions, for decades. Okay, bomb in a good way. HSAs are often misunderstood as just a piggy bank for current medical bills. But for high earners, they're a stealth wealth-building machine with a triple tax advantage. First, your contributions are tax-deductible, or pre-tax if it's through your employer, which lowers your adjusted gross income, AGI. For 2025, if you have a qualifying high-deductible health plan, you can contribute up to $4,300 for self-only coverage or $8,550 for family coverage. Plus, there's an extra $1,000 catch-up if you're 55 or older. Quick note, these are the 2025 figures I have, but HSA limits can nudge up each year. Always double-check the current year limits with official IRS info. Second, the money in your HSA can be invested and it grows completely tax-free. This is huge. Unlike an FSA, the money rolls over year after year. Many high earners actually treat their HSA like an extra retirement account, investing the funds for the long haul. Third, when you take money out for qualified medical expenses, those withdrawals are completely tax-free, anytime, whether that's now or in retirement. Think about that, a tax deduction when you put money in, tax-free growth, and tax-free withdrawals for medical costs. No other account does all three. Many top earners max out their HSA, try to pay for current medical stuff out of pocket if they can swing it, and just let their HSA balance grow into a hefty medical nest egg for retirement. It effectively becomes another tax-advantaged investment account. Giving to charity is obviously a great thing to do, but it can also be a pretty smart tax-saving strategy, especially for those with higher incomes who can itemize their deductions. The key is to be strategic about it. One common tactic is bunching contributions. The standard deduction is pretty high these days, $15,000 for single filers, $30,000 for married filing jointly in 2025. Because of this, a lot of people don't actually get a tax benefit from their charitable gifts each year because their total itemized deductions don't add up to more than the standard. Bunching means you concentrate several years' worth of donations into a single year. So, instead of giving, say, $5,000 a year for 3 years, you might give $15,000 in 1 year. This could push you over the standard deduction threshold for that year, letting you deduct the full amount. Another really powerful strategy is donating appreciated securities. Think stocks or mutual funds you've held for over a year that have gone up in value, directly to a charity instead of just giving cash. Why is this so good? You generally get to deduct the full fair market value of the securities when you donate them, and you skip paying capital gains tax on all that growth. It's a double win. Imagine you bought stock for $10,000 and it's now worth $50,000. If you sold it, you'd owe capital gains tax on the $40,000 profit. But if you donate it directly, you could potentially get a $50,000 deduction and pay zero capital gains. Nice, right? For larger, more complex giving, donor-advised funds, DAFs, are popular. You contribute assets, cash, stocks, whatever, to the DAF, get an immediate tax deduction, and then you can recommend grants from the fund to your favorite charities over time. The assets in the DAF can also grow tax-free. This gives you flexibility and a current year tax break even if you haven't quite decided which charities will get the funds just yet. Real estate investing has been a favorite for wealth builders for ages, partly because of its unique tax advantages. The most famous one is depreciation. Even if your rental property is actually going up in market value, the IRS lets you deduct a portion of the property's cost, the building itself, not the land, each year as a paper loss. This depreciation expense can offset your rental income, sometimes making it tax-free. If your depreciation and other expenses create a net loss on your rental property, you might even be able to deduct that loss against your other income, like your W-2 salary, but there are limits. This is where real estate professional status can come into play. If you, or your spouse, qualify as a real estate professional by spending a significant amount of time in real estate trades or businesses, you might be able to deduct larger rental losses against your other income. This is a major strategy for high-income folks who are seriously involved in real estate. Another advanced tactic is a cost segregation study. This is where you break down the components of a commercial or rental property, like carpet, fixtures, landscaping, and speed up the depreciation on those shorter-lived assets, instead of depreciating everything over 27.5 or 39 years. This can create much larger depreciation deductions in the early years of owning a property, which can really boost your cash flow by cutting your taxes. And don't forget about 1031 exchanges, or like-kind exchanges. This lets you sell an investment property and put off paying capital gains taxes if you reinvest the proceeds into another like-kind property within a specific time frame. It's a way to keep growing your real estate portfolio while deferring that tax hit, sometimes indefinitely, like until you pass away, and then your heirs might get a step up in basis. That's a whole other angle. If you own a business, how it's structured and how you manage its expenses can make a massive difference to your tax bill. Choosing the right entity structure is fundamental. Many small businesses start as sole proprietorships or LLCs, where profits get hit with self-employment tax, currently 15.3% on top of income tax. As your business grows and profits pass a certain point, often people say around $80,000 in net profit, electing to be taxed as an S-corporation can be a game changer. With an S-corp, you pay yourself a reasonable salary, which is subject to payroll taxes, and then any additional profits can be taken as distributions, and those are not subject to self-employment tax. This can save you thousands. C-corporations have their own set of rules and potential benefits, like a flat corporate tax rate, which might be better for very large businesses or those looking to reinvest heavily. Then there's the qualified business income, QBI, deduction, also known as Section 199A. This allows eligible pass-through entities, like sole proprietorships, LLCs, S-corp, and partnerships, to deduct up to 20% of their qualified business income. There are income limits and rules depending on the type of business, but for many, this is a hefty deduction. It's worth noting this provision, which came from the Tax Cuts and Jobs Act, is currently set to expire after 2025 unless Congress extends it. There's even some talk about expanding it to 23%. And of course, deducting legitimate business expenses is critical. This is more than just office supplies. Think home office deductions. If you're self-employed and meet the strict criteria, vehicle mileage, travel, a portion of utilities, health insurance premiums for the self-employed, and even employing family members in actual roles to shift income to lower tax brackets. Keeping super meticulous records is the key to maximizing these. High-income earners often hit a frustrating wall. They earn too much to contribute directly to a Roth IRA. For 2025, the income phase-out for Roth IRA contributions for single filers starts somewhere around $150,000 to $165,000, and for married couples filing jointly, it's around $236,000 to $246,000. So, no tax-free growth for them, right? Wrong. Enter the backdoor Roth IRA. This is a perfectly legal move where you make a non-deductible contribution to a traditional IRA, which doesn't have income limits for contributions, though whether you can deduct it might be limited. Then, shortly after, you convert that traditional IRA to a Roth IRA. You'll pay income tax on any pre-tax money or earnings in the traditional IRA at the time of conversion, but if you do it quickly with a new, empty traditional IRA, the tax hit can be minimal or even zero on the contribution itself. Once that money is in the Roth, it grows tax-free, and qualified withdrawals in retirement are tax-free. Boom! Then there's the mega backdoor Roth IRA. This is a more advanced strategy, usually for people whose employer's 401k plan allows for two things. 1. After-tax contributions. These are different from Roth 401k contributions, beyond the standard employee deferral limit, and 2. In-service distributions or conversions of those after-tax amounts to a Roth 401k or a Roth IRA. If this option is available, it can let you put a lot more into a Roth vehicle, way beyond the usual limits. We're talking potentially tens of thousands more per year, all growing tax-free. These strategies need careful handling, especially the pro rata rule if you have existing traditional IRA balances. But for high earners who are locked out of direct Roth contributions, they are golden tickets to tax-free retirement wealth. This one is more about smart investing with taxes in mind. High earners often have pretty big investment portfolios, and how they manage those can make a huge difference to their tax bill. Tax loss harvesting is a common move. If you have investments in a taxable brokerage account that have lost value, you can sell them to realize a capital loss. This loss can then be used to offset capital gains from selling profitable investments. If your losses are bigger than your gains, you can use up to $3,000 of that excess loss to reduce your ordinary income each year and carry forward any leftover losses to future years. It's a way to find a silver lining when some investments don't pan out. On the flip side, tax gain harvesting can be useful sometimes. If you happen to be in a lower tax bracket for a particular year, maybe your income dipped temporarily, or you had other big deductions, you might intentionally sell some appreciated assets to realize long-term capital gains at a 0% or 15% rate, instead of waiting until you're in a higher capital gains bracket. You could even then repurchase the same assets, which resets your cost basis to a higher level, reducing future capital gains. Asset location, don't mix this up with asset allocation, is another pro tip. This is about strategically putting different types of investments into different types of accounts to minimize taxes. For example, tax-efficient investments like broad market index funds or ETFs, which don't spit out a lot of taxable income year to year, are good for your regular taxable brokerage accounts. Tax-inefficient investments, like actively managed funds that generate a lot of short-term capital gains, or taxable bonds, are often better off inside tax-advantaged accounts like 401(k)s or IRAs. Their income and gains can grow tax-deferred or tax-free. This might seem like a small detail, but over decades, getting your asset location right can save you a substantial amount in taxes. Phew! That was a ton of information, but hopefully, you're starting to see that the tax code isn't just a burden, it's actually full of opportunities if you know where to look. We've covered supercharged retirement accounts, the amazing HSA, strategic charitable giving, real estate perks, business structuring, backdoor Roths, and smart investment tax strategies. And that's not even everything. Plus, the rules are always changing with new laws and IRS updates. For instance, many of the Tax Cuts and Jobs Act provisions are set to expire after 2025, which could really shake up strategies for a lot of people. There are also always discussions about things like the SALT cap deduction and potential new credits or deductions. So, staying informed is definitely key. The main message here is about empowerment. You don't have to just sit back and passively accept your tax bill. By understanding these concepts, you can start having much smarter conversations with your financial advisors and CPAs. Now, I'm really curious, which of these strategies surprised you the most? Or which one are you most interested in digging into more? Let me know down in the comments. Your questions and experiences can help everyone in this community learn. If you found this info valuable and you want more insights into building wealth, optimizing your finances, and making sense of the often confusing world of money, make sure you hit that subscribe button and ring the notification bell. That way, you won't miss our future videos. And now, for the really important bit, I am not a tax advisor, and this video is purely for educational and informational purposes. Tax laws are incredibly complex and very specific to your individual situation. Before you try to implement any of these strategies, it is absolutely essential that you talk to a qualified tax professional, a CPA, or a financial advisor. They can give you advice that's tailored to your unique circumstances and make sure you're following all the rules and regulations. Seriously, don't try to DIY complex tax planning based only on a YouTube video. The road to tax efficiency isn't about finding some magic secret. It's about learning continuously, planning strategically, and getting the right professional help. The top earners don't necessarily have secrets so much as they have a proactive approach to understanding and using the rules of the game. Now you have a much better idea of what some of those rules and opportunities actually are. Go out there and start planning. Thanks for watching, and I'll see you in the next one.